945, or you could also, I guess I'd prefer, if you have a choice, of keeping above that predicted high of 942 and making that stop at 952 on the upside, because that's kind of more of a natural place where you might expect the reversal to take place and the trend to change. Okay, a lot about soybeans. This is kind of a quick overview of what happens to with the indicators that you have at Vantage Point. We'll take a look at some other, as I mentioned earlier, JP Morgan. We aren't going to spend as much time on them because we simply don't have it, and stocks are a little differently. But just to take a quick look at them, I have the same types of indicators that already are on these charts. We have the JP Morgan chart. This happens to be a chart that goes back to about February 1st, so it's a little longer than that 2-month chart we were talking about before. When we look at this particular chart, when we're talking about stocks, again, it depends a little bit on how you trade stocks, how you want to trade stocks, what you think about stocks. As you may recall, when you look at the charts and recall what was going on, everything was pretty much negative about stocks. Everybody was kind of, I'm never going to have stocks, and kind of down in the dumps when the market was down in this vicinity right here. But that's the time when you want to be ready to jump on and be prepared for a move to the upside, kind of one of those that pops out through the top side, or, eventually, if the market had rallied up a little bit, popped down through the lower side, penetrated that lower side, and then the move might continue on down. But in this case, we knew that the market had gone down from where it was. It was at a relatively low area. So we get February 9th when we're talking about how are we going to trade this particular market. And February 9th, we have a situation where the predicted high on February 9th was 38.36. Now, I'm arbitrarily saying we're going to buy $1 higher. It might be different, for you or for somebody else. So we're going to buy $1 higher at 39.36 is where we're going to buy. Now, how many shares are you going to buy? That's going to depend a little bit, again, on you and, again, on your parameters. Remember, we said we were talking about a situation where we have a $20,000 account. In stocks, you're probably not going to risk a whole bunch of, to put all your eggs in one basket, so to speak. So let's say we're just going to work with 100 shares, and that may be more or less than you want. But when you factor everything else out, and keep in mind that you're trying to limit your risk, we're talking about a decline of about 60 cents being your bailout point where you're going to get out. And in this case, another way to calculate that is, what is 97% of the price that you got in? Well, 97% of 39.36 is approximately 38.18, which would put that right in here. And that would be where you would have your stop initially. Then as the market goes up, you're going to be keeping a trailing stop right below those predicted lows. You want to keep, let's say, for again, arbitrary decision, $1 below. You'll also notice as you go along here, there's some different places where you potentially could have added on positions, where you had the rallies, where if you had your orders in place to add at $1 above those kind of breakouts like that, where you could have added on in a couple of different cases. It all depends, again, on your strategy, how much you want to trade, how actively you want to be, how much risk you want to take. On April the 15th, we get into the middle of April, and we have a situation where the market has moved up. And again, remember what we talked about, those previous highs. Traditional traders are looking at them. Pretty important spot right here. It reaches the predicted highs. And then on April 16th, we have a situation where the market suddenly almost virtually collapses, and have a situation where, in this particular case, the predicted low in this case was 47.34. So using our $1 criteria, 46.34, we're going to be out of that stock market position, and we're going to sell it. So from 46.34 where you sold to 39.36 where you enter, you had almost $7 in profit times 100 shares, $700 shares. Again, the important point here is not all of those kind of particular dollars and cents, but look at what we have here for the various indicators that are setting up. First of all, we had the blue line moving up. We had the predicted moving average definitely moving up, and then we had the predicted moving average eventually, of course, definitely moves down. So the trend is pretty clear. The crossover that occurs right in there, and occurs right in there. Signals at which you might start to take some action, where you have the crossover, and you also had the predicted difference. In this particular case, we had the predicted difference. It started up in the early part of the trend, pretty strong, but after a while, it just can't maintain quite that much strength, but it does stay on the stronger side, because for this whole period of time during this uptrend, it is above the zero line, not really weakening appreciably, but it is staying pretty strong throughout the whole length of that particular move. Now, when you get to this point, when you get to April 16th, and you're saying you should be short, a lot of people do not like to short stocks. I'm one of those. So you have several different choices. First, if you are looking at what you potentially could do to enter the market, you could short the stock, of course. Secondly, you could keep the stock, sell covered calls. If you get a situation where you have the stock in hand, you have the opportunity where the market has moved up, gets a little volatile, the premium gets a little bit richer, good place to sell, perhaps like 50 calls. Or you could buy puts. Any number of possibilities that you could use, including where you have the situation available to you that you can use with options. When you look down here at the bottom, current situation, it looks to me like the kind of a choppy situation throughout this period right in here, but we are talking about a situation where the VIX reading is still relatively high, well above 30. I would say that possibly if you're looking at just at the chart and not thinking about all these worries and concerns and so forth about what could happen next, and the world's going to hell in a handbasket and all that kind of stuff, where you might want to be long again, J.P. Morgan, by taking that predicted high of 38.85, buying a dollar above it at 39.85, and that's where you would be today. Now again, the other alternative, you could sell puts. Maybe they're expensive enough, maybe they're rich enough that you could then sell puts and be able to take that money, put it in your account, let the market work its way up. Options obviously have their own concerns, and you need a little experience with them, but it is a possibility that you could sell puts and accomplish the same thing. Of course, you could also buy a call, bit on the expensive side. Okay, now we're going to do one quick look at, and we don't have a lot of time, but I want to take one quick look